The global economy of early 2026 is defined less by recession or boom than by a growing sense of structural tension. On the surface, capital markets appear calm, even euphoric in pockets. Equity indices hover near highs, venture funding continues to chase scale, and the language of a transformation dominates earnings calls. But beneath this composure sits a widening mismatch between what the digital economy believes it can build and what the physical world is capable of sustaining. This is not a typical cycle, it is a decoupling. At the center of this tension sits artificial intelligence. The AI build-out of the last 3 years rivals the great infrastructure waves of history: railroads in the 19th century, electrification in the 20th. Fiber optics at the turn of the millennium. Once again, capital is racing ahead of constraint. Once again, the narrative assumes that scale will resolve friction. And once again, the friction is real, material, and increasingly impossible to ignore. The defining error of the current AI cycle is not optimism, it is the assumption of frictionless intelligence. Markets have priced AI as if computation were weightless, deployable at the speed of code, and limited only by capital and silicon. In reality, intelligence is physical. It consumes electrons, it generates heat. It depends on grids, transformers, cooling loops, water rights, permitting timelines, and regulatory tolerance. The financial superstructure of AI rests on a physical substructure that has not kept pace. By early 2026, the scale of this mismatch is no longer abstract. New AI-dedicated data centers in the United States alone now demand roughly 25 gigawatts of continuous power. This figure is easy to gloss over in spreadsheets, but devastating when translated into physics. 1 gigawatt is the full output of a large nuclear reactor or hydroelectric dam. 25 gigawatts implies an entire fleet of nuclear plants running at full capacity, dedicated not to cities or factories, but to inference, engines generating probabilistic tokens. This is not incremental growth, it is a structural shock to the energy system. For most of the 2010s, electricity demand in the United States barely grew at all, averaging roughly 0.2% annually. Data centers have shattered that equilibrium. Utilities now project load growth exceeding 5% per year, with more than half of that increase attributable to data centers alone. In practical terms, AI has become the single largest driver of new electricity demand in the country. Even these figures understate the problem. Utility forecasts often exaggerate to secure reserves, but even conservative adjustments point to a looming gap between projected demand and available capacity. By 2028, expected AI-related demand could reach over 40 gigawatts, while committed generation lags far behind. The result is a gigawatt gap, not solvable by software updates or financial engineering. Inside the data center, the consumption profile has changed as well. Traditional facilities devoted much of their energy to cooling and storage. AI facilities are compute engines. Roughly 60% of their electricity feeds GPU packed into dense racks. Cooling still consumes around 20%, despite aggressive adoption of liquid cooling. Because the thermal density of modern accelerators continues to rise, networking and storage account for the remainder. Efficiency gains in power usage effectiveness have largely plateaued. Air cooling has hit its limits. The shift to immersion and liquid cooling adds capital cost, complexity, and new dependencies on water and specialized infrastructure. When translated into annual consumption, the 25 gigawatt figure becomes even starker, approximately 219 terawatt hours per year. That is more electricity than Pakistan consumes annually. It is roughly equivalent to the entire national demand of Vietnam. It is nearly double the consumption of the Netherlands. AI has quietly surpassed Bitcoin mining as the largest single digital sink of energy on the planet. This creates an uncomfortable global asymmetry. Billions of people still live in energy-poor regions where per capita electricity use remains insufficient for basic human development. At the same time, advanced economies are allocating nation-scale energy budgets to power large language models whose economic output remains uncertain. As hyperscalers lock in long-term power purchase agreements, they effectively sequester baseload capacity from broader markets. Energy is not destroyed, but it is removed from circulation, with price consequences that ripple outward. This strain becomes most visible at the grid level. While GPU can be deployed in months, transmission infrastructure operates on timelines measured in years or decades. Interconnection queues across North America now stretch 4 years or more. High-voltage transformers and switch gear face lead times approaching 4 years due to global manufacturing bottlenecks. Capital cannot compress these timelines. Faced with this reality, hyperscalers have begun to vertically integrate into energy itself. Instead of waiting for grid capacity, they are buying it. Microsoft's multi-billion-dollar deal with a former Bitcoin miner to secure 3 gigawatts of power was not about data centers. It was about access. Similarly, sovereign wealth funds are underwriting massive generation projects dedicated exclusively to data centers. Energy availability, not silicon supply, has become the binding constraint. This marks the first act of the Great Decoupling. Financial markets continue to extrapolate exponential intelligence growth. The physical system responds linearly, grudgingly, and with hard limits. The gap between these two realities is where instability forms. And this instability does not remain confined to power grids. It propagates directly into the financial structure built on top of them. The financial consequences of this physical constraint are already visible, though often misinterpreted. Capital expenditures across the major technology firms have reached levels without precedent outside wartime mobilization. By 2026, more than $500 billion a year is being deployed into silicon, data centers, and power infrastructure. This spending is frequently described as investment, but structurally, it resembles an industrial build-out with long depreciation cycles, low flexibility, and heavy exposure to input costs. Historically, technology booms have been characterized by declining marginal costs. Software scaled cheaply. Cloud computing promised elastic capacity. AI reverses that trend. Each additional unit of intelligence requires more hardware, more electricity, more cooling, and more physical footprint. The marginal cost curve is flattening, not collapsing. This distinction matters because valuation frameworks still assume software economics in an industrial system. The earnings reports of the largest firms reveal this tension in plain sight. Revenue growth remains strong, but margins are compressing. Microsoft's cloud business continues to expand rapidly, yet its gross margin has fallen as AI infrastructure weighs on costs. The company now operates closer to an industrial utility than a pure software platform. Energy, depreciation, and maintenance costs do not scale away. They accumulate. This shift marks the end of the software margin era and the beginning of what might be called industrial intelligence margins. In this regime, profitability depends less on code elegance and more on supply chains, energy contracts, and capital discipline. The hyperscalers that can internalize chip design, secure power at predictable prices, and amortize infrastructure over massive user bases gain an advantage. Those that cannot face, structurally, lower returns. The illusion of effortless monetization is further reinforced by a phenomenon quietly embedded in the current growth figures: circular financing. Hyperscalers invest billions into AI startups, which then spend that capital almost exclusively on the hyperscalers' own cloud platforms. Money exits as venture investment and re-enters as revenue. On paper, cloud growth accelerates. In substance, demand is internally subsidized. This loop masks the fragility of underlying demand. If startups fail to build profitable applications, the revenue evaporates while the infrastructure remains. GPU depreciate, Data centers cannot be easily repurposed. Power contracts persist. The risk is not a sudden collapse in usage, but a slow recognition that much of the current demand was self-generated. The divergence in market narratives reflects this ambiguity. One camp views the AI build-out as a classic bubble, excessive capital chasing a transformative technology before its economic utility is fully realized. History offers many parallels. Railroads were overbuilt. Fiber optics were laid in abundance. Each crash destroyed capital, but left behind productive infrastructure that later generations used cheaply. Another camp argues that this cycle differs fundamentally. Today's leading firms are profitable, cash-rich, and operationally sophisticated. They are not speculative startups, but entrenched platforms with diversified revenue streams. According to this view, the infrastructure will be absorbed into real productivity gains across healthcare, finance, and industry, justifying the spend. The disagreement ultimately hinges on utilization. If AI infrastructure delivers sustained, high-value output at scale, the capital will earn its keep. If it does not, the system will confront overcapacity under rising energy costs. Physical constraints make this a binary outcome more than a gradual adjustment. The grid itself introduces additional fragility. Reliability assessments now warn that demand growth is outpacing the ability to add firm capacity. Extreme weather events expose the brittleness of a system already stretched by constant, non-interruptible AI load. When storms reduce renewable output, grids rely on reserves that are no longer abundant. Price spikes and localized outages are no longer anomalies, they are previews. Regulation adds another layer. Intelligence, environmental, and resource constraints are forcing governments to scrutinize data center expansion. Water usage, waste heat, and carbon intensity are becoming political liabilities. Moratoriums once unthinkable are now openly discussed. Each regulatory delay compounds the mismatch between financial expectations and physical feasibility. Even within the energy sector, competition for grid access is intensifying. Bitcoin miners, once vilified, now possess something hyperscalers desperately want: existing interconnections. Converting these sites into AI facilities unlocks massive valuation arbitrage, but removes flexible load from the grid. Utilities face a trade-off between interruptible demand and permanent strain. All of these forces converge on a single question: intelligence. When enterprises compare cloud-based inference with on-premise deployment, the economics increasingly favor ownership for sustained workloads. Hardware pays for itself in months. Over years, cost differences become orders of magnitude. As rational actors respond, cloud growth slows, and the revenue assumptions embedded in current valuations weaken. This is the heart of the decoupling. Digital capital assumed infinite scalability. Physical reality enforces scarcity. Energy prices rise. Margins compress. Infrastructure persists long after narratives change. The system does not implode overnight. It grinds, recalibrates, and eventually reprices. What remains is not failure, but correction. The intelligence infrastructure being built will matter. It will enable productivity gains and new capabilities. But the capital that built it may not be rewarded proportionally. As with railroads and fiber, the builders and the beneficiaries may not be the same. The era of infinite compute is giving way to an era of constrained intelligence. Power, grid access, and unit economics now define the frontier. Markets that ignore this reality risk mistaking physical limits for temporary noise. In systems governed by thermodynamics, such mistakes are never forgiven. To understand where this trajectory ultimately leads, it helps to strip away valuation debates and return to first principles. Every economic system is governed by constraints. In past decades, the binding constraint for digital businesses was talent or distribution. For AI in 2026, the binding constraint is energy delivered reliably, cheaply, and at scale. When a system encounters a hard constraint, behavior changes abruptly, not gradually. The most important implication of this shift is that intelligence is no longer a purely digital good. It behaves like a manufactured commodity. Its cost curve is shaped by power prices, depreciation schedules, and capacity utilization. This is why the rhetoric of AI as software is increasingly misleading. What is being built resembles an industrial base layered with algorithms, not the other way around. Once intelligence becomes industrialized, classical economics reasserts itself. The intelligence layer will persist and permeate the economy. This is where PRICE, competition, COMPRESSES, Hikatorzes MORGINS enzygy becomes instructive. Margins determine survivorship. The current market is already showing the early signs of this transition. Token prices are collapsing, particularly at the low end. Entry-level models are approaching commodity pricing, even as their production costs remain sensitive to energy inflation. Attempts to restore pricing power through premium offerings introduce their own problems. More complex reasoning models consume more compute per task, increasing energy intensity. The marginal revenue per token may rise, but so does marginal cost. The system begins to chase its own tail. Efficiency gains in model architecture are real, but they cannot fully offset thermodynamic realities. This is where PRICE, competition, COMPRESSES, Hikatorzes MORGINS enzygy becomes instructive. In the late 19th century, railroads were hailed as transformative, and they were. But investors learned the hard way that transformative does not mean profitable at any price. Overbuilding led to brutal consolidation. The rails remained. The capital returns did not. The same pattern repeated with electrification and telecommunications. Overcapacity leads to price competition. The intelligence layer will persist and permeate the economy. The question is not whether AI wins. This is where PRICE, competition, COMPRESSES, Hikatorzes MORGINS enzygy becomes instructive. In environments defined by heavy fixed costs and commoditized outputs, surplus often accrues downstream to users rather than upstream to builders. Cheap intelligence benefits consumers, enterprises, and governments. It does not necessarily reward the firms that race to build it. This realization reframes the current melt-up narrative. Equity markets can sustain elevated valuations as long as earnings, momentum holds, and capital remains abundant. But earnings momentum itself is increasingly dependent on accounting structures, internal demand loops, and optimistic assumptions about future pricing. When physical constraints tighten, those assumptions are stress-tested. Energy costs provide a clear example. Power purchase agreements signed in a low-rate environment look very different when grid scarcity emerges. Utilities facing capacity shortages renegotiate. Regulators intervene. Wholesale price volatility increases. Data centers, designed for constant load, absorb the shock directly. Unlike software bugs, power shortages cannot be patched. The regulatory response compounds the effect. Environmental mandates, water restrictions, and zoning limits introduce delays and uncertainty. Each delay increases capital intensity and reduces effective return on invested capital. What appears manageable in isolation becomes destabilizing in aggregate. At the macro level, these dynamics intersect with broader financial fragility. The global economy remains highly leveraged. Debt levels are historically extreme. In such systems, rising fixed costs and declining margins reduce resilience. A deflationary shock does not require widespread failure. It requires a loss of confidence in growth narratives that justify leverage. This is why the distinction between a bubble and a foundational build-out is less binary than it appears. Both can be true. Infrastructure can be essential and still be overbuilt. Capital can be misallocated even when the underlying technology is real. The danger lies in assuming that technological inevitability guarantees financial reward. From this perspective, the most important risk in 2026 is not technological disappointment, but economic mispricing. Markets have priced AI as if it were exempt from industrial logic. The evidence increasingly suggests the opposite. Intelligence is subject to the same forces that govern steel, electricity, and transportation: supply, demand, and constraint. The likely path forward is uneven. Some firms will adapt by securing energy early, optimizing utilization, and integrating vertically. Others will find themselves trapped with expensive assets producing low margin output. Consolidation will follow, capacity will be written down. The survivors will operate in a more sober environment, one where growth is earned rather than assumed. For policymakers, the implications are equally complex. AI promises productivity gains, but it also concentrates resource use. Decisions about grid investment, energy mix, and industrial policy now shape the trajectory of digital intelligence. Neglecting physical infrastructure while celebrating digital innovation creates systemic risk. For investors, the lesson is uncomfortable but familiar. Returns follow economics, not narratives. When a sector's success depends on continuous capital inflows to sustain demand for its own output, caution is warranted. When profitability relies on ignoring input constraints, correction is inevitable. None of this implies the end of AI. It implies the end of illusion. The intelligence age will not be defined by infinite compute, but by constrained optimization. The firms that thrive will be those that treat power, cooling, and capital as strategic assets rather than background assumptions. In that sense, 2026 marks a transition point. The era of speculative abstraction is giving way to an era of physical reckoning. The decoupling between digital ambition and material reality cannot persist indefinitely. It resolves through repricing, restructuring, and, ultimately, realism. What emerges on the other side will likely be more durable, more integrated, and less euphoric. Intelligence will be cheaper, more widespread, and more useful. But it will no longer be mistaken for magic. It will be recognized for what it is: a powerful, energy-hungry industrial capability operating within the immutable laws of physics and economics. Enterprises that rushed into cloud-based AI pilots are quietly reassessing their long-term cost structures. Final implication of this shift is psychological as much as economic. Markets are not merely discounting cash flows, they are discounting stories. For the past 3 years, the dominant story has been one of boundless acceleration. Intelligence, we were told, would scale like software, compound like capital, and defy the historical limits that constrained earlier industrial revolutions. That story is now colliding with a more ancient narrative, one written not in code, but in copper, steel, and thermodynamics. When stories fail, behavior changes, capital becomes more selective, time horizons shorten, risk tolerance compresses. This is how regime shifts occur without a single dramatic event. The AI cycle does not require a spectacular crash to mark its transition. It requires only the steady accumulation of evidence that returns are lower, slower, and more contingent than promised. Already, subtle adjustments are visible. Enterprises that rushed into cloud-based AI pilots are quietly reassessing their long-term cost structures. Procurement teams are running the numbers and discovering that ownership, not rental, restores predictability. Governments that once competed to attract data centers are asking harder questions about water use, grid resilience, and local benefit. Utilities are repricing risk. Investors are beginning to distinguish between firms that command physical leverage and those that merely consume it. This sorting process is not a failure of innovation. It is its maturation. Every transformative technology eventually exits its mythic phase and enters its accounting phase. Railroads stopped being symbols of destiny and became balance sheets. Electricity ceased to be magic and became a regulated utility. The internet moved from exuberant speculation to quiet ubiquity. AI is following the same path, compressed into a shorter, more volatile time frame. The danger lies in mistaking this normalization for collapse. Infrastructure cycles are messy because they intertwine genuine progress with financial excess. Capital overshoots, capacity accumulates, and prices fall. Those price declines feel catastrophic to investors, but are often precisely what unlock widespread adoption. Cheap intelligence will do more to reshape the real economy than expensive intelligence ever could. The question, then, is not whether AI will transform productivity, but at what cost to the capital that financed its birth. In 2026, the answer is becoming clearer. Much of the return will accrue outside the balance sheets of the firms that built the infrastructure. It will show up as lower operating costs, faster workflows, and incremental efficiency gains across thousands of industries. That is social surplus, not necessarily shareholder surplus. This distinction matters because modern markets have become accustomed to conflating the two. We assume that technological benefit and investor return are aligned. History suggests otherwise. The more foundational the infrastructure, the more likely its benefits are diffused. The more capital-intensive the build-out, the more likely competition erodes margins. AI checks both boxes. Energy is the fulcrum on which this outcome turns. If power were abundant, cheap, and infinitely dispatchable, many of these tensions would soften. But power is none of those things. It is scarce, politically sensitive, and slow to expand. Every forecast that ignores this reality underestimates friction. Every valuation that assumes away energy constraint is fragile by construction. The most resilient actors in the next phase will be those who internalize this truth. They will treat energy contracts as strategic moats, not line items. They will design systems for efficiency rather than maximal scale. They will prioritize utilization over headline capacity. In short, they will behave less like software startups and more like industrial operators. For everyone else, the adjustment will be forced rather than chosen. Rising costs will expose weak economics. Regulatory delays will disrupt timelines. Overbuilt capacity will pressure prices. None of this requires malice or incompetence. It is the natural outcome of mismatched expectations meeting physical reality. Seen from a distance, the arc is almost elegant. Digital ambition raced ahead, untethered from material constraint. Capital followed, amplifying the momentum. The physical world responded slowly, predictably, and without regard for narrative. Now the two are reconnecting. That reconnection feels like tension because it is. In this sense, the great decoupling of the early 2020s was always temporary. Economies cannot sustain prolonged divergence between financial abstraction and physical capacity. They reconcile through cycles of excess and correction. AI is not exempt from this law. It is simply the latest domain in which it asserts itself. What comes next is not an end, but a recalibration. Intelligence will become a standard input, priced more like electricity than software licenses. The firms that survive will be those that planned for constraint rather than abundance. The capital that survives will be the capital that demanded discipline rather than scale at any cost. The story of 2026, then, is not one of collapse but of convergence. Digital capital is being pulled back toward physical reality. Expectations are being re-anchored to energy, infrastructure, and unit economics. The mythology of infinite compute is fading, replaced by a more grounded understanding of what intelligence actually requires. This is how revolutions mature. The magic wears off, the machinery remains, and the world quietly reorganizes itself around what is truly possible, rather than what once seemed inevitable.